Okay, so today we're going to do another update on Jinko Solar stock. I got some good news for you and some bad news. This has definitely been one of my roughest stocks to deal with because, as you can see, I'm down about 25%, over $1,100. Definitely not fun to look at. But the past couple of months have been looking better. We bottomed out at about $30 a share. It shot up to 46, and then now we're back to 38. So let's start going through this. The original reason I picked this company was because I Googled something like biggest solar company, okay? And the first thing that pops up is this list right here on Investopedia, and you can see that number one is Jinko. And so I thought that was a great sign. Then I kept doing more research. I found articles like this that said they were working on the biggest bifacial solar panel project ever built in Europe, okay? These are all positive signs. I looked at the PE ratio and it was like a 10 or it was under 10. It was something very low. So I started buying it up. Then the stock started falling under $50. I kept buying and buying. And next thing you know, I have almost $5,000 in here and I'm down 25%. So then today I was looking at things a little bit more in detail, like some of these charts. And you can see that if I were to see these things before I invested, all these different financials and these ratios, I probably would not have put as much money in here. I probably would not have bought it at all if I was looking at all the stuff that I'm seeing now. So I remember going through their investor presentation, and the profit margins and the financials looked a lot better. Other problem was no one could have expected the pandemic to cause this, that we had a pandemic. Now we have all these supply chain issues, and that was unpredictable. So there was no way I could have known that. And that's pretty much their biggest problem at the moment, because that's what's hurting profit margins and sales. So as you can see, over the years, they've kind of been slowly growing. I would say the revenue growth has been pretty steady, not bad. But then as you get into profitability, you can see that net income is very low and it's all over the place. It goes from 700, 800, 1900, 100, 400, 900, and then 230 for 2020. And keep in mind, this is in the Chinese currency. So it's actually about 1/6 of that number is in American dollars. So then we go down to the profit margins. We can see in the past, it's been as high as 21%, and then it started coming down, and now it's at 17%. Then you go to operating margin and things get worse and worse. Profit margin, they're barely making a profit. And for 2020, their profit margins was 0.7%, okay? Then let's go on to the next thing. Other big problem is the debt. So if we look at the debt here, we can see that it definitely could be worse. It's not horrible, but so they have, the cash is 16, we'll say 16 billion. Okay, we'll say 16 billion, even though it's in Chinese currency. So total current assets 33, total current liabilities 31. Okay, so at least they have more assets than liabilities, but still not the best. Total assets 53, total liabilities 40. Still not the best ratio, but it could be worse. Okay, then we go to cash flow, and we can see that once again these numbers are all over the place. So they've been investing lots of money, taking out lots of debt. Operating cash flow has been just up and down. Net cash flow, same thing. Free cash flow, they're losing money. So that's a big deal. If this company is losing money on the free cash flow line consistently and it's all over the place, that's not good. Now, here is the thing that's very misleading. So for one, any Chinese company is going to trade lower than an American company, even with the same business model. So like a Alibaba compared to an Amazon, that's why Alibaba trades so much cheaper. Or like I own another Chinese stock named Baozun. That one, great business model, great metrics and everything, but because it's Chinese, it trades at a cheaper valuation. So if we look at PE ratio, over the years, it's been pretty cheap. It's been 8, 1, 35, 5, 6, and now it's 78. So that looks really bad. Then price to sales, here, see, these are the misleading parts. The price to sales ratio is 0.3, 0.1, and this year it's 0.5. And that is extremely low, okay, super low. That seems like you're getting a great deal. However, you have to compare it to where it was in the past. And in the past, it's traded at 1/5 of that. And a half of that before. So technically, compared to the last 10 years or so, this is actually a more expensive time to buy the stock. And you can see that over the last 5 years, it was pretty steady between this $13 range to $28. And then out of nowhere, it skyrocketed, short squeeze or whatever happened, and now we're back down to 38. So other big problem I don't like here is, so the debt's a big problem. The profitability margins are bad. Could be temporary just for right now because of the supply chain issues. We'll get to that in a little bit. But also the return on equity, return on assets. Look at these percentages: 0.5% return on assets, 2% return on equity. That's horrible. That's not good at all. And other things we can look for is there is a 15% of the shares are shorted. So again, there is another chance that there could be another short squeeze. That's why I'm going to keep holding my shares. And once we go over $50 a share, I'll probably start selling, and just because I just want a smaller position. Then a 4 PE of 10 or 11, that's pretty low. That's not bad. And let's see what else we got here. Big problem here: total debt $4 billion, cash $2.4 billion. That's not good at all. Once again, financial efficiency ratios are bad. And so let's get into some more stuff. So what we have here is just talking about how the materials used to make solar panels has, over the past year, especially in 2021, been skyrocketing. And I mean, they did talk about that in the past week or so. It's been stabilizing a little bit. It has not been increasing as much, but still not good. And then if you read this article, we can see that it says, according to analysts, polysilicon prices are expected to remain high through the end of 2022. So that means another year and a half, which that's not good news at all. So we're just going to keep watching this. They report earnings in 2 days? June 25th. Yeah, 2 days. I mean, if they're expected to lose 2 cents a share, I mean, if they can beat that and report a profit, and they have good numbers or good guidance or something, and the stock shoots up, then that would be great. But we'll see what happens, and I will keep you guys updated. Thanks for watching.